Welcome back to the deep dive. We're here to cut through the noise, get straight to the core insights from the sources you choose.
That's right.
And today, wow, you've handed us Mike Maloney's Guide to Investing in Gold and Silver, a book that, well, it makes some incredibly bold claims about finance, about history, and where we might be heading.
It really does.
Maloney isn't just giving out investment tips here. He's basically suggesting we're staring down a massive economic shift, something that could, reshape wealth for generations.
Absolutely. And that's why this deep dive, it's less like your typical investment guide.
Right.
It's much more a provocative, maybe even controversial look at our whole financial system.
Okay.
Maloney's core argument is that understanding how money and currency cycle through history isn't just, academic trivia.
No.
No, he says it's a vital tool, critical for protecting your wealth, maybe even growing it, especially doing what he calls the greatest wealth transfer in history.
The greatest wealth transfer.
Yeah,
Quite a phrase.
it is. So our mission today is really to unpack his main arguments, look at these surprising historical parallels he draws,
It does sound fascinating.
and then get into his practical advice, how to navigate what he genuinely sees as an oncoming economic storm. He believes this knowledge is, well, indispensable.
Okay, powerful stuff. Let's jump right in then. Maloney kicks things off with something he sees as absolutely fundamental, the difference between money and currency. Now, that sounds simple, maybe, but he argues that misunderstanding this is, like, the root problem for a lot of people.
It's totally foundational to everything else he says. He draws this really clear line, and it surprises a lot of people.
Okay, so what's the line?
He defines currency as just a medium of exchange. Think paper cash, the numbers in your bank account. It works for buying stuff, but crucially, it does not store value reliably over time.
Right, it loses purchasing power,
Yeah.
inflation.
Exactly. But money, in his definition, has intrinsic value within itself. And it can be used as currency, too. Think gold, think silver.
Yeah. Ah, okay. So money holds value, currency
Mhm.
just facilitates transactions.
Precisely. And he emphasizes that pretty much all currencies today, the dollar included, are fiat currencies.
Fiat, meaning backed by...
Nothing tangible, just government decree. Faith, essentially. Trust in the system.
Yeah.
Not backed by gold or anything physical.
And Maloney's big claim is that this fiat system, it has a built-in flaw, not just a bug, but like a feature.
That's exactly his point.
Yeah.
He argues quite strongly that fiat currency is actually designed to lose value.
Designed to? How so?
Well, he says every new dollar or euro or whatever that gets created out of thin air, it silently steals a tiny bit of purchasing power from all the dollars already out there.
Okay.
He calls it an insidious stealth tax known as inflation. The idea is if you're just holding cash, your wealth is constantly quietly shrinking.
So it's not an accident that things cost more over time?
Not in his view.
Yeah.
It's the inevitable result of a system without a real anchor, without that intrinsic value. And this pattern, he says, it's played out again and again throughout history.
And gold and silver always come out on top in the end.
That's his assertion. They always win against these debased fiat currencies,
Yeah.
eventually.
That's a huge claim. He must back that up with history, right? What examples does he use to make that case? They must be pretty compelling.
Oh, yeah. He digs deep. He takes us way back. Starts with ancient Athens, 407 BC.
Athens. Wow.
Yeah, they were stuck in a long war and needed money, so they started mixing cheaper metals into their silver coins, debasing the currency.
And the result.
Predictable, right.
Mm.
The value of the money collapsed. Didn't help their empire much either.
Okay, so that's one. Where else?
Then he points to Rome, the Roman Empire. Over like 750 years, he says they perfected the art of currency debasement.
Perfected it.
That's his phrase. Constantly reducing the silver in their denarius coin to pay for wars, big building projects,
Leading to...
staggering hyperinflation. Get this. In AD 301, 1 pound of gold cost 50,000 denarii.
Okay.
Just 50 years later, that same pound of gold cost 2.12 billion denarii.
Billion. That's hard to even grasp.
It's an increase of 42,400 times against gold. Shows you how worthless the currency became.
Incredible. So it's not just ancient history then. He connects this to more recent events too, right? These patterns keep showing up.
Absolutely. He talks about things like the Dutch tulip mania in 1637. Where tulip bulb prices went completely insane before crashing.
Right, speculative bubbles.
Exactly. Shows what happens when too much currency chases too few. Well, tulips in that case. But more directly related to currency itself, he discusses John Law's experiment in France, early 1700s.
John Law, wasn't he the guy with the paper money scheme?
That's him. He thought printing more paper currency would boost the economy. And initially, it seemed to work. There was a boom.
Oh.
Yeah, it led to wild speculation, especially in the Mississippi company bubble. But the whole thing imploded within just 4 years.
4 years.
Yep. Devastating collapse. Plunged France into a depression that lasted for decades. A real cautionary tale about pure paper currency.
And I guess the most famous modern example he uses must be Weimar Germany.
Weimar? Yes. That's the textbook case, isn't it? Post-World War I Germany. Hyperinflation like you wouldn't believe.
The wheelbarrows full of cash.
Exactly. Stories needing billions, then trillions of marks just for basic goods. He quotes a figure. A pair of shoes costing 12 marks before the war cost 30 trillion marks by late 1923.
30 trillion.
And gold. Its price in marks went up by 87 trillion%.
Just staggering.
And Maloney's key point through all this is that wealth isn't actually destroyed in these crises.
It's not.
No, he says it's transferred.
Yeah.
It moves from people holding the currency that's becoming worthless
To
people holding tangible assets, like gold and silver. He calls it their undefeated track record. History proves it time and again, in his view.
Okay, those historical examples are, well, they're pretty sobering. But the big question Maloney forces us to ask is, are we seeing similar patterns now?
Right.
Let's pivot to the U.S. financial system today. Maloney really goes after the Federal Reserve, doesn't he? He doesn't mince words.
No, he certainly does not. He calls the Fed one of the most notorious and misunderstood institutions. Quite a label.
Notorious. Why?
Well, he claims it's essentially a privately owned bank with stockholders.
Oh, I thought it was part of the government.
That's the common misconception he points out. He argues it has the power to create currency from nothing, yet it's shielded from audits, from direct congressional oversight in many ways. And he brings up that story, the secret meeting back in 1910 on Jekyll Island.
Vaguely, yeah. Bankers getting together.
Exactly. A group of powerful bankers, he says, who concocted a bill to create this private central bank. His point is, the system we have wasn't an accident. It was designed.
And part of that design involves how money or currency is created today. He talks about fractional reserve banking.
That's right. And it's a concept many people have heard of, but maybe don't grasp the full implications Maloney sees.
Okay, break it down for us.
He explains that when you deposit money, the bank doesn't just hold it or lend that specific money out. They only have to keep a fraction, a small percentage, in reserve.
Right.
The rest, they can lend it out. But here's the kicker. When they make that loan, they essentially create new fiat dollars out of nothing. Just digital book entries.
Create it.
He calls it bunny money because it multiplies.
Bunny money, okay.
Yeah, you deposit $1,000, they keep maybe $100, lend out $900. The borrower deposits that $900 somewhere else. That bank keeps $90, lends out $810. And boom, the money supply expands.
Through lending.
Through lending, based on that initial deposit. And this, combined with government deficit spending borrowing money into existence, means the currency supply is constantly expanding, diluting the value of every dollar already out there.
And Maloney connects this to specific historical steps the U.S. took, right? Kind of a slow walk away from sound money.
Exactly. He traces this path. Starts with the income tax in 1913, giving the government a new revenue stream. Then you have the gold exchange standard, kind of a halfway house, the 1929 crash. Then a really big one, 1933. Roosevelt confiscates gold from citizens.
They actually took people's gold.
Made it illegal to own most forms of gold bullion. Maloney sees this as the government prioritizing its own control over individual property rights.
And the final nail in the coffin, so to speak.
1971. Nixon. Severing the dollar's last tenuous link to gold internationally. The gold window was closed.
And the significance of that 1971 move, in Maloney's view?
Game over for fiscal restraint, basically. He argues it freed the U.S. dollar completely, allowed the government to run massive deficits, pay for them by creating currency, and effectively export inflation, taxing the whole world, since the dollar was the reserve currency.
Taxing the world through inflation.
How? By devaluing the dollars held by other countries and individuals globally. If the supply goes up, the value of each dollar goes down everywhere.
Wow. Okay, and he says this whole system makes it hard to see true value. That assets might look like they're rising, but they're not really?
Exactly. He calls it an invisible crash.
Yeah.
Your stocks might go up in dollar terms. Your house price might go up in dollar terms. But if those dollars buy significantly less stuff, less energy, less food, less gold, have you really gained wealth? Or are you just keeping pace or even falling behind in real terms?
Which is where those charts come in, right?
Uh.
Measuring the Dow in gold, not dollars.
Precisely. And those charts are startling. They often show the Dow's value, measured against gold or oil, has actually fallen significantly or gone sideways for long periods, like since 1999, even while the dollar price was climbing.
It really makes you question what price means.
It's meant to. It's a challenge to conventional thinking about wealth. And this leads directly into his attack on the official inflation measure, the CPI.
The Consumer Price Index, he calls it the
CPI.
Haha, okay, that's blunt. So the CPI is how the government tracks inflation, right? Price changes for consumers.
That's the official story.
Yeah.
But Maloney claims the Bureau of Labor Statistics, let's say, massages the numbers.
What does he claim they do?
He points to a few key techniques. First, deletion. They take volatile things like food and energy out of the core CPI calculation.
But we buy food and energy all the time.
Exactly. Second, substitution. If steak gets too expensive, they assume you'll just buy cheaper chicken instead, so they adjust the index downward. And third, hedonic adjustments. This one's tricky. They say if a new computer is faster or a car has more features, even if it costs more, the quality improvement offsets the price hike. So officially, the price hasn't really gone up that much for a comparable item.
So they're saying we're getting more even if we're paying more.
Essentially, yes.
Yes.
Which masks the true cost increase for a basic functional equivalent. He points to work by people like John Williams at Shadow Government Statistics.
Shadow stats, yeah, I've heard of them.
Right. They recalculate CPI using the older original government methodologies from decades ago, and guess what?
Inflation looks much higher.
Much, much higher, consistently. Which, if true, means our purchasing power has been eroding way faster than the official numbers suggest.
Okay, this is painting a pretty concerning picture. Maloney describes the current economic landscape as a perfect economic storm. What are the storm clouds he sees gathering?
He talks about this dark cloud, made up of several things. Global trade imbalances, huge U.S. budget deficits, those massive unfunded liabilities we mentioned.
Right, the Social Security, Medicare promises.
Yeah, he cited figures back in 2006, putting them at $160 trillion, growing way faster than the economy. It's like this giant off-balance sheet debt.
$160 trillion, that's astronomical.
And he talks about the pillage of Social Security, where the supposed trust funds are just filled with government IOUs spent on other things.
And a derivatives monster? What's that about? Sounds ominous.
Derivatives are those complex financial contracts, right?
Yeah.
Value based on underlying assets. Maloney echoes Warren Buffett here, calling them potential financial weapons of mass destruction.
Because of the leverage, the complexity.
Both. Huge leverage, interconnectedness, lack of transparency. He argues they pose a massive systemic risk, a potential trigger for a cascade failure.
He also mentions something called the financialization of government. What does he mean by that?
It means the government's own finances, its tax revenues, are becoming increasingly dependent on the stock market doing well.
How so?
Think capital gains taxes. When markets boom, government revenues boom. So Maloney argues this creates a situation where the Fed feels compelled to step in and rescue Wall Street whenever there's a downturn.
To protect tax revenues.
Essentially, yes. Because a market crash would crater tax receipts, making government spending commitments impossible to meet.
And the consequence of those rescues.
More currency creation, more bunny money, more debasement. He even speculates that the next big crash might require creating something like $16 trillion just to bail things out.
16 trillion. That's more than the entire existing money supply, roughly.
Exactly. And that kind of expansion, he argues, that's how you potentially trigger hyperinflation, the end game for the currency.
Wow. Okay. So given this, let's call it a bleak forecast.
He definitely sees it that way.
Maloney obviously points towards precious metals, gold and silver. He makes an incredibly strong statement. There is no possible scenario in which gold and silver do not rise.
It's about as bullish as you can get, isn't it?
No kidding. What gives him that level of certainty? Is it just the history repeating?
It's largely that, yes. The historical precedent. Fiat fails, hard assets prevail. But he also sees them not just as insurance, but as potentially the best performing investment during these crisis periods.
Better than stocks or bonds?
In real terms, measured against the failing currency, yes. That's his argument. And he's particularly keen on silver.
Why silver specifically?
Several reasons. He notes governments globally hold very little silver reserves compared to gold. They're effectively out of silver, he says. Plus, he points to data, like from 2006, showing the public becoming net buyers of silver for only the third time ever.
Signaling a shift in sentiment.
A potential major shift. combined with shrinking mine production and this huge paper market for silver, futures contracts, etc., that vastly outweighs the actual physical metal available, he sees potential for a massive price squeeze, a real supply crunch.
Okay, so he's incredibly bullish, but he also warns about pitfalls, right? Things to avoid if you do decide to invest in metals.
Absolutely crucial. He spends a lot of time on this. First, big warning, be wary of ETFs, exchange-traded funds, for long-term holding.
Why? They seem convenient.
Convenient, yes. But he argues they're not the same as holding physical metal. They're financial instruments, part of the system he thinks is fragile. Yep. There's counterparty risk, and he even suggests they might be used by institutions to manipulate paper prices downward.
Okay, so ETFs are maybe not for the true believer wanting physical. What else?
Pool accounts and certificate programs. He basically calls these IOU gold or silver someday.
Meaning you don't actually own specific metal?
Often, no. Or it's unallocated. You have a claim, but not ownership of specific segregated bars or coins. He warns these can even function as a short position for the company, offering them they benefit if the price goes down or if they don't actually have the metal to deliver. His mantra is, if you don't hold it, you don't own it.
Makes sense. Any other big pitfalls?
Leverage. Using margin, futures, options, he strongly advises against this for average investors. Says the math works brutally against you. If the price moves down even slightly, it cuts like a surgical laser on the way down. High risk.
So stick to buying what you can afford outright. What about the type of physical metal? Collector coins versus plain bullion.
Huge difference in his eyes. Numismatic or collector coins, he points out, have very high dealer markups. 15%, 50%, even 100% or more over the metal value.
Because their value is subjective, rarity condition.
Exactly. It's subjective. Bullion bars and common bullion coins like gold eagles or silver maple leafs have much lower premiums, maybe 1 to 5% over the metal spot price. Their value is tied directly to the metal content.
So get more metal for your money with bullion.
Generally, yes. He's skeptical of newly minted collectible coins sold at high premiums, suggesting true historical rarity was usually accidental, not manufactured for profit.
Does he recommend anything besides standard bullion?
He mentioned a couple of things he personally invests in. Investment grade, bullion jewelry, basically high-carat gold jewelry brought close to melt value, and also semi-numismatic coins like pre-1933 U.S. $20 gold double eagles, but in lower circulated grades.
Why those specifically?
They're still mostly valued for their gold content, but because they're historical and somewhat rarer than modern bullion, he thinks their premiums could explode in a crisis as people seek them out. They're less common.
Interesting niche. Okay, what about taxes and reporting? People worry about the government tracking this stuff.
Right, he clarifies this. When you buy precious metals in any quantity using non-cash methods, there are generally no IRS reporting requirements for the dealer. You can accumulate privately.
Okay, buying is private. What about cash?
If you use cash for a purchase over $10,000, then the seller, the dealer, has to report that transaction. Same as buying a car with cash.
Got it. And when you sell?
When you sell back to a dealer, reporting depends on the specific item and quantity. Some things trigger reporting, like selling a kilo gold bar or 25 one-ounce gold maple leafs at once.
But not everything.
No. Importantly, selling American gold eagles or silver eagles or common fractional gold coins generally does not require the dealer to file a report.
That's good to know.
But, and this is crucial, Maloney stresses that regardless of dealer reporting, you are legally obligated to report any capital gains you make when you sell on your own tax return.
Yeah.
That's your responsibility.
Makes sense. Finally, then, how does he recommend actually holding this physical metal if you want it outside the system?
He strongly pushes for a core position held physically outside the banking system. Several options.
Like?
Holding some at home. Offers the most privacy, direct access, useful as emergency currency in a true crisis. Obviously, you need to think about security.
Sure. What about vaults?
Professional vault storage is another key option. But he distinguishes between segregated and allocated storage.
What's the difference?
Segregated means your specific bars and coins are identified, counted, and stored separately under your title, like your own little section of the vault. Allocated means you own a certain number of ounces within a larger pool of metal held by the vault, but not specific identifiable pieces.
So segregated offers more direct ownership.
Yes, stronger claim, less ambiguity. He also mentions digital precious metals currency online platforms where you can buy, sell, and store metal that is physically backed and owned by you, often with lower storage fees and easy trading.
And his own portfolio, how much does he allocate?
As of his 2015 update, He mentioned having 50 to 70% of his portfolio in physical precious metals.
Wow, that's a heavy allocation.
It is. The rest was in things like mining stocks, other commodities, cash held outside banks, and even a small allocation to Bitcoin, which was new in that update.
Okay. So, quite a journey we've taken. Through ancient history, the mechanics of fiat currency, the Fed, inflation metrics, potential storm clouds,
Right.
and ending with very concrete advice on gold and silver, all through Mike Maloney's lens.
Mm-hmm.
His core message seems crystal clear. History doesn't just rhyme, it repeats. Fiat currencies eventually fail. Gold and silver endure. And we might be living through one of those major transfer periods right now.
That's the essence of it.
Mm.
He concludes by saying this colossal cyclone is coming, but knowing about it is your defense. It arms you.
Knowledge is power.
Exactly. He paints this picture of, men of clear vision, seeing this unfold and preparing, while maybe 99% of people are unaware. He genuinely sees this not just as a time to protect yourself, but as an opportunity to potentially, significantly improve your standard of living without taking crazy risks, just by understanding these cycles and positioning accordingly.
A truly profound perspective, and certainly a lot for us to chew on. It leaves us with a pretty pointed question for you, our listener. If Maloney is right, or even partially right, if the system is subtly transferring wealth from the uninformed to the informed, are you ready? Are you positioned to be on the winning side of what he calls the greatest wealth transfer in history?
A big question indeed.
What steps might you consider to build a financial foundation that could withstand that kind of economic storm? Something to think about. Thanks for joining us on this deep dive.